Welcome to Money Minds, where our mission is to make finance fun and easy to understand. We know that the world of finance can seem complicated and intimidating, but it doesn't have to be. Whether you're a veteran investor or just starting out, we're here to help you navigate the financial landscape with clarity and confidence. Today we're going to explore a fascinating topic: the growth of your investments. We'll delve into a simple yet powerful tool that can help you estimate how long it will take to double your investment. This tool, known as the Rule of 72, can be a game changer in your financial journey. So buckle up, grab a notepad if you want, and get ready to demystify the world of investments. Because remember, knowledge is power, and the more you understand about your money, the better decisions you can make. So, are you ready to dive in? Let's get started. Ever wondered how long it would take to double your investment? Let's face it, whether you're a seasoned investor or just testing the waters, the growth of your investment is always a question of interest. It's like planting a seed and watching it sprout into a tree. You've got to understand the nature of growth, the conditions that foster it, and the time it takes. In the world of investments, time and growth share a unique relationship. The magic happens when you let your investments grow over time, harnessing the power of compound interest. But wouldn't it be fantastic if you could estimate the time it'll take to double your investment? Just think about it. Knowing how long it would take for your money to grow twofold, without complex calculations or financial jargon. Well, guess what? There's a handy tool that can help you do just that. It's called the Rule of 72. This simple formula can give you a quick estimate of the time it will take to double your investment, and it's about to become your new best friend in the investing world. So, are you ready to demystify the growth of your investments? Well, there's a simple formula that can give you a quick estimate: the Rule of 72. The Rule of 72 is a handy tool used to estimate the time required to double an investment or the annual rate of return. This rule is a mental math trick that's been around since the 15th century. It was first referenced by Luca Pacioli, an Italian mathematician and friend of Leonardo da Vinci. Today, it's a staple in the toolbox of investors around the globe. So what exactly is the Rule of 72? Picture it as a shortcut, a quick and easy way to estimate how long it will take for your investment to double, given a fixed annual rate of return. It's as simple as dividing the number 72 by your expected rate of return. For example, if you expect a return rate of 6%, you would divide 72 by 6, resulting in 12. This means it would take approximately 12 years for your investment to double. The beauty of the Rule of 72 lies in its simplicity. It doesn't require complex mathematical calculations or fancy financial software. It's a rule you can apply using just your mind and perhaps a piece of paper, making it an ideal tool for beginners dipping their toes into the world of investing. But don't underestimate the Rule of 72 based on its simplicity. While it might be a basic calculation, it's a powerful one. It's particularly effective in scenarios involving compound interest, the type of interest where your earnings are reinvested and you earn additional interest on those earnings. The Rule of 72 provides a clear, uncomplicated way to understand the impact of compound interest on your investments over time. In essence, the Rule of 72 is a bridge that connects you to the future of your investments. It provides a snapshot of what your financial future could look like based on the decisions you make today. It's a simple yet powerful rule that applies to compound interest scenarios. It's a rule that, when understood and applied, can guide you on the path to achieving your financial goals. So, how does the Rule of 72 work? Let's break it down together, shall we? The essence of the Rule of 72 is a simple division operation. The number 72 is divided by the expected rate of return on an investment. For instance, if you have an investment with an annual interest rate of 6%, you would divide 72 by 6. The result, 12, is the approximate number of years it will take for your investment to double. Now you might be wondering, why 72? Why not 70 or 75? Well, 72 has a multitude of factors, making it a versatile number for mental calculations. It's also close to 100, which makes it a handy estimate for interest rates close to around 8%. But remember, the Rule of 72 is not precise. It's a quick mental calculation tool for investors to get a ballpark figure. The exact doubling time for an investment is calculated using a logarithmic equation, a bit more complex and requiring a calculator. The logarithmic method involves using the natural logarithm of 2, divided by the natural logarithm of 1, plus the interest rate. If you're not a math whiz, don't worry, most of us aren't. That's why the Rule of 72 is so helpful. It's a quick and simple way to get a close approximation without diving into logarithms. Also, it's important to note that the rule of 72 is most accurate for interest rates between 6 and 10%. For rates outside this range, adjustments can be made by adding or subtracting from 72. For instance, for lower rates, you might use 70 instead of 72 for a more accurate estimate. In conclusion, the rule of 72 is a handy tool for investors, providing a quick estimate of when an investment will double. It's a simple division operation that can be done mentally, making it a great tool for on-the-spot calculations. And that's how you use the rule of 72 to estimate your investment's doubling time. The rule of 72 is not just a rigid formula, it's also flexible. This flexibility is what makes it such a powerful tool for investors. The rule of 72 is an approximation, and while it works well for rates of return between 6 and 10%, it can also be adjusted to accommodate rates outside this range. Picture this: if you're looking at an investment that promises a return of 12%, simply dividing 72 by 12 would give you 6 years for your investment to double. But in reality, due to compounding, your investment would double a bit faster. To adjust for this, you can subtract from 72. The adjusted rule might be the rule of 70 or 69. This will give you a more accurate estimate. On the other hand, if you're considering an investment with a low rate of return, say 2%, dividing 72 by 2 would suggest 36 years for your investment to double. But again, due to the power of compounding, it might take a bit longer. In this case, you can add to 72 to adjust the rule. It could become the rule of 74 or 75. The beauty of this flexibility is that it allows you to tailor the rule to your specific investment scenario. It allows you to get a more accurate estimate of how long it will take for your investment to double, no matter the rate of return. This flexibility is what makes the rule of 72 such a valuable tool. Whether you're a seasoned investor crunching numbers for a high-stakes portfolio, or a beginner trying to understand how your modest savings could grow, the rule of 72 can provide a quick and easy way to understand the potential of your investments. Remember, while the rule of 72 provides a good approximation, it's always a good idea to do a more detailed analysis for important investment decisions. It's a starting point, a way to get a quick grasp on the potential of an investment. With these adjustments, the rule of 72 can be tailored to fit a wider range of investment scenarios. The rule of 72 is more than just a simple math trick, it's a flexible tool that can help you plan your financial future. But what does the rule of 72 really mean for your investments? Well, let's dive in and decipher its significance. At its core, the rule of 72 is a powerful tool that brings clarity to the complexity of investments. It's like a compass guiding you through the murky waters of financial markets, illuminating the effects of fees, inflation, and growth rates on your investments. Let's start with fees. We all know they can eat away at your returns like termites to wood. But how quickly can they do that? The rule of 72 gives you a clear picture. If you're charged a 2% fee, divide 72 by 2. The result? 36. That means your investment would take 36 years to double if all you were dealing with were fees. Now, that's a perspective you wouldn't want to ignore. Next up, inflation. Often referred to as the silent thief, inflation subtly erodes the purchasing power of your money. Let's say the inflation rate is 3%. Using the rule of 72, you'll find that your money would lose half its value in about 24 years. It's a wake-up call to investors about the importance of investing in assets that at least keep pace with inflation. And then, we have growth rates. This is where the rule of 72 really shines. Let's say you're considering an investment that promises an annual return of 6%. Divide 72 by 6 and voila, you get 12. This means your investment would double in about 12 years. It's a quick and easy way to compare the potential of different investments. So, you see, the rule of 72 is not just a mathematical curiosity, it's a practical weapon in your financial arsenal, a lens that brings the future into focus, helping you make more informed decisions about where to put your hard-earned money. The rule of 72 can be a game changer in the world of investing. The power to predict the future isn't in a crystal ball. It's in the numbers, and the rule of 72 helps you decipher them. So there you have it, the rule of 72 in a nutshell. This simple yet powerful formula is a mental calculation tool that investors have been using for centuries, dating back to Luca Pacioli in 1494. It's a swift and efficient way to estimate the time required to double an investment or the annual rate of return. The beauty of the rule of 72 lies in its flexibility. Whether your expected rate of return falls within the 6 to 10% range or sits outside it, you can adjust the rule by adding or subtracting from 72. This rule isn't just about numbers on a page though. It's about understanding the impact of fees, inflation, and growth rates on your investments. The rule of 72 provides a close approximation, illuminating the power of compound interest and the potential of your investments. Next time you're wondering about your investment's growth, remember the rule of 72, your quick mental calculator. That's all for today's episode on the rule of 72. I hope you now have a better understanding of this powerful tool and how it can help you make more informed investment decisions. Remember, the rule of 72 isn't just a formula, it's a window into the potential of your investments. I want to thank you all for taking the time to watch this video. I hope it has given you some valuable insights into the world of investing. I encourage you to apply the rule of 72 in your future investment decisions and see the magic of compound interest work for you. If you found this video helpful and want to learn more about the world of finance, don't forget to hit that subscribe button. We have a lot more content coming your way, filled with financial tips and tricks to help you on your journey to financial freedom. Until next time, keep investing smart, and remember, the power of your investments lies in your hands. Thank you for watching, and we'll see you in the next video.